again from Core Wealth. It's fast moving to the end of the year, and today we're going to be having a look at what happened in October 2021. It's quite a big month for markets, and I'll be unpacking what drove that, how it's impacted our clients' portfolios, and as usual having a look ahead and trying to give you some insight into how we see things unfolding in future. In the last two monthly wrap-ups, we've spoken a lot about China and the regulatory clampdowns that have happened there, as well as inflation, particularly in the US, and the impact of that on interest rates globally. Those are still two of the biggest news items, but I'll actually unpack that in more detail when we talk about our outlook later on in the video. The other item that has been high on the news agendas in the last month has been the oil price, and we've seen that spiking as there's been a shortage of basically gas, and many economies have switched to oil because gas supplies are so low, and that's been driving up the oil price, which we expect to stay at these levels even though they've increased supply for a little while still, which could have further knock-on effects to emerging market inflation in particular. So the month of October was really good for equity markets. So the developed world markets were up strongly, up almost 7% for the month. The South African equity market followed suit, was up just over 5% for the month of October, with particularly resource companies and your industrial companies doing very well in the month of October. The listed property market and bond markets took a bit of a breather in South Africa, and they were down 1.7% and 0.5% respectively. But if we look over the last year, the listed property market was still the best place to have been in terms of South African investors. The interesting thing that we saw in the month of October was we saw the start of further weakening in the rand against the developed world currencies. And we've seen the rand now on a year-to-date basis soften by between 4.3 and just over 6% against the dollar, the euro, and the pound. It's weakened the most against the pound as we've seen the UK looking at increasing interest rates fairly soon, which is always supportive of a country's currency. So if we have a look at the longer term returns now, and just starting with 1 year, you can see some really strong returns over the last year. The global equity market's up just over 31%, the South African equity market up 36%, the South African listed property market up just shy of 66% over the last year. And so these have driven longer term portfolios which have more exposure to what we call growth assets, being shares and listed property. But if we have a look now at over the last 3 years, 5 years, and even the 10-year number, South African equities getting to the level where, in terms of returns, that you'd see in a more normalized situation. And over the 3 years now, the South African equity market up 12.6%. Compare that to inflation over the same period of just 4%. That's a real return, or a return above inflation, of over 8%, which is a good return for any investor, both in South Africa and globally. The stronger markets in October did lead to some good absolute returns, so the numbers were strong for the month as a whole. And if we look back over the last year as well, some really strong returns from the more aggressive or growth focused funds that have more shares in them. If we look through the portfolios and have a look at which areas drove things and which areas weighed on things, our exposure to developed market listed property was a really good performer in the month, as was our exposure to the 91 Global Franchise Fund, which is more of a growth focused strategy, high in equities, and some high exposure to the US market, which benefited it during the month. Some of our bias towards more valuation-driven strategies weighed a little bit on performance just for the month. But if we have a look at the longer-term performance, especially the last year, absolute numbers really strong, as one would expect, but then some good outperformance versus the peers, and since inception as well, the relative performance versus our peers looking good. So if we have a look at our local models, on average in the last year, we've outperformed our peers by 5.2%, which is one of our best years ever that we've had. And if we have a look at our global models, they have outperformed peers in the last year by 4.3%, which we're particularly pleased about, and that's in US dollar terms. The last number of months we've been talking about what's been happening in China. We've seen a clampdown in terms of regulations, and the impact of that is that we've seen the tech sector in China take a huge hit, down some 50%, as you'll see from this index that we're showing you. Some of that pullback in prices was justified, but a lot of it was actually more narrative driven, where the media was sort of getting on a bandwagon and overemphasizing things, and we've seen those prices come down more than is actually warranted. The Chinese government is trying to encourage investment into more growth-orientated businesses that are going to invest in China and invest in manufacturing and things like that, while wanting to ensure that there's proper competition between businesses. And those were some of the things that inhibited share prices in the last while. But looking through all of this noise in the short term, we do still think that exposure to China is something one will be rewarded for in the longer term. So the other thing in China was the Evergrande situation, the property developer that couldn't pay its debts. There's concern that there may be other developers like Evergrande that will come out of the woodwork, and the government is trying to manage this impact on the economy to make it as small as possible. This has created some nervousness around emerging markets in general, and we've actually had an overweight position to emerging markets in the last year, which, when you look at the returns of emerging market equity versus developed market, would have been a drag on our portfolio, on our performance. However, we've still managed to generate outperformance versus our peers, as we mentioned in the previous section. So we think this will play itself out of the system, and investors will be rewarded for exposure both to China and to emerging markets in the coming years. If we have a look at the US now, that economy is overheating in a sense. The inflation has gone up. The Federal Reserve wants to slow things down. They can do that in two ways: increase interest rates or reduce the amount of liquidity in the system by tapering their bond purchases, is the phrase that's used. We've seen in the past that when the market anticipates there's going to be some handbrake on the economy by the Federal Reserve, that interest rates in the bond market go up. And that's the red line on this graph that we're showing you now of US bond yields. And once they implement their strategy that the market's been anticipating, we actually see an improvement in the bond market, or we see bond yields come down, and therefore the price of bonds will go up. And we've seen that happen in the past, as shown on this graph, but in the current scenario, we've actually seen the market anticipating that they will start to either taper or increase interest rates, and so we've seen the bond market yields go up, and we expect, now that they've announced that they will start the implementation of this tapering, that we'll see bond yields soften in the coming months. So the oil price globally is high, and that's just a function, as I mentioned earlier, of short supply of gas and therefore greater demand for oil. We've seen that have a knock-on effect onto fuel prices, and in particular in South Africa we've seen petrol prices go up quite strongly. However, markets tend to overreact, and so the concern that's feeding through at the moment is, well, is inflation going to get further out of control? We don't think it is, but markets at the moment are pricing in some very high interest rate increases to try and quell inflation in South Africa. We don't think this is going to materialize, and if we look at how things are unfolding globally, global equities are expensive, but they're not very expensive versus global bonds. And if we see the global bond market improving, we could see a nicer landing, as it were, for some of the global equity markets. The South African equity market and emerging markets continue to look very attractive from a valuation point of view, and so we think there are a number of tailwinds that could still benefit growth assets over the coming years, and that will be good for clients' portfolios. So I hope that gives you a bit more insight into what has recently happened and some of our expectations going forward. We've given the outside of the offices a little bit of a facelift, just trying to help clients and potential clients know both where we are and what we do. And it's just got me thinking around a few things coming to this time of year. At the moment, we are busy recording and doing presentations around medical aids, and so the new medical aids will usually kick in on the 1st of January. So if you've got questions or thoughts around that, please be in touch with your advisor. The short-term insurance, if you change short-term insurance at this time of the year, most of the insurers will have limitations on claims. So, please be in touch with us or Sam to just talk through any thoughts you have if you were thinking of changing short-term insurers. And then lastly, just in preparation for next year, we'll before we know it, we'll probably be into January, and then we get closer to tax season. So if your taxes need to be sorted out, perhaps you've got some backlogs or some bookkeeping that needs to be done, remember that we've actually have that service available here, and we'd love to help you get those things in order if you need to get that done. Trust this has been helpful, and look forward to seeing you again soon.